Hi everyone, and welcome to a special webinar about how investors stay ahead of the market. My name is Asher Abraham from OurCrowd's Investor Relations team. I'm honored to welcome Michael Sonnenfeld, founder and chairman of Tiger 21, and John Medved, founder and CEO of OurCrowd, for an interview-style conversation. Since the topics of this discussion is relevant to all investors, we'd love to get any questions pertaining to the conversation. Since we have a very large group on the line today, if you have any questions, please type them in the GoToWebinar control panel chat feature. Or if you're just dialing in through your phone without a computer, you could just email me directly at Asher, A-S-H-E-R, at ourcrowd.com. Today we have the pleasure to hear from Michael Sonnenfeld. Michael's an American entrepreneur, philanthropist, and political activist. Currently, he's the founder, owner, and chairman of Tiger 21, the premier investment and learning peer group for high net worth investors. Members come from many major cities, from virtually every segment of the economy. And on a side note, Tiger 21 is joining us as a premium sponsor at the upcoming Investor Summit in Jerusalem next month. Michael's also a chairman of Magnolia Purchasing Advisors, chairman of Carmanah Technologies, which is a publicly traded Canadian solar company. He's also a member of Earth Justice, a president of Goldman Sonnenfeld Foundation, and on the board of several other philanthropic and political organizations. Thank you for joining us today, Michael.
My pleasure.
Leading the conversation is John Medved. For those of you who are not familiar with John and OurCrowd, John is a serial entrepreneur and investor. He's been a part of the founding team of several successful Israeli startups, and as a venture and angel investor over the past couple of decades, he invested in over 200 startup companies, helping to grow a dozen of them to over $100 million in value. The Washington Post named John as one of Israel's leading high-tech venture capitalists, and the New York Times named John as one of the top 10 most influential Americans who have impacted Israel. John is the founder and CEO of OurCrowd, the world's largest equity crowdfunding platform for accredited investors. Just this week, OurCrowd was named one of the global top 10 most innovative fintech companies by KPMG. Thank you for joining us, John. Please take it away.
Hi there, Michael. Good to have you with us today. Great. So I think we would all benefit by just hearing a few minutes on your story and how you started Tiger 21. Tiger 21 is, I think most of the people probably on the air know a little bit about it, but they'd love to hear the backstory of how you came up with the idea and how you got started.
Sure. So Tiger was founded in 1999 after I had sold my second significant business and had what you would call my second liquidity event. And the first time I had sold a business when I was 30, it happened so quickly that I really didn't have much time to think about wealth preservation and longer term issues. And when you're 30, you don't tend to think about those things. And so I had a liquidity event, and then I made a lot of investments, and things like asset allocation weren't all that important to me. And I went a little backwards in that I made some risky investments, some of which didn't pan out, and I realized this was no way to run a portfolio. And I started a second business, and it was 10 years later, and now in my early 40s I was having a second liquidity event, and I said there's got to be a better way to manage passive investments and to preserve wealth and think about the issues that entrepreneurs face. And there's a well-known model in the United States, either called YPO or Vistage, two different CEO organizations. So we created a peer-to-peer learning group in confidential settings, and today, 16 years later, we have 380 members with a net worth approaching $40 billion and total assets of about $100 billion under management by our members. We're not an investment manager, we're an organization of investors. So today we're recognized as the premier network of confidential peer-to-peer learning groups for high net worth investors. And as I mentioned, there are over 30 groups all across North America in most of the major cities. and across Canada as well. And I think we're reasonably well recognized as the leader in our space.
So you mentioned asset allocation, and that was sort of the key to your sort of bright idea moment in terms of building Tiger 21. Give us your, sort of secret sauce. What do you think the best practice is? I mean, you hear so many different recipes and different ideas. What have you distilled from the best practice of you and your members over the last, decade plus at Tiger 21?
Yeah, so one has to do with process and one has to do with results. And we drive a process that allows each of our members to become more and more explicit about how they think about assets. Most entrepreneurs reached the liquidity event by having built a single business where they had focused all of their assets and all of their work in a single opportunity, and that would be the death of any investor. So when you're talking about a passive investor, you want to find that right combination of diversification without diversification. And I'm just flipping to the slides to give you a sense of.
Have you patented that diversification? Is that a Tiger 21?
No, I don't even own it. I'm happy to repeat somebody else's insight, but it's so important because what happens is a member typically joins after they sell a business, and they've gone from having one investment that created all their wealth, and they just don't have well thought out historic norms for whether they should have 100 investments or 10. And different allocations have different. And I think in your introduction you mentioned, or it was mentioned, that you would make 200 investments. Well, when you're seeding venture capital, you tend to have more investments than when you're in a typical private equity situation or public equity because of the risks. So I think what happens is the riskier the assets, the higher the number of assets that you want, with each a smaller percentage. So when one is a really big hit, it still makes a difference. But if they're a loss, they don't. And the best way to think about that is in venture capital, typically you find that you might lose money on, I don't know what your track record is, 2 or 3 or 4 out of 5. But if the 1 or 2 out of 5 that's successful has a 10 or a 20 or 100 to 1 hit, you still have an amazing return overall. So you can afford to lose 60 or 80% of the time and still be one of the most successful people in the world. But at the same time, if you're a real estate lender and only one of your loans out of 10 goes bad, you could be out of business. So this tolerance for risk and losses is very specific to the asset class and the riskiness. But on the screen here, what I'm showing is when we poll our members and say collectively, if you believe in the wisdom of crowds, collectively, what are our members doing these days? And at one end is cash and cash equivalents, which typically hovers around 9 or 10%. It's gotten as high as 12%. And if you think that our members are living, remember, our members have net worths from 10 million to $1 billion, with the largest number in the 30 to $50 million range, but the average, the numerical average, closer to 100 million. And so they're sitting with 9 or 10% in cash. But today they're also sitting in 20%, that's the pink, in private equity. Obviously within the private equity would be venture capital, but that's an all-time high. That number used to be close to 10% a decade ago. And part of the reason that it has grown is a reflection of who Tiger 21 members are. Most of our members made their money in private equity, so when times get tough, like after 2008, they realized they had been buying a lot of financial products that were sophisticated and so confusing that they didn't realize the risks that they had. They kind of wanted to go back to basics and own pieces of companies like the venture capital opportunities that you're doing. They wanted to be part of startups, and if you were a Tiger member that had printing press company and we're in the publishing business, and now all of a sudden you've sold, you might not be investing in printing presses, but you might be investing in digital publishing, thinking that one expertise allowed you to go to the other. So the other allocations here, 24% in public equity, 28% in real estate, obviously a portion of that is homes, but most of it is investments, 11% in fixed income, probably an all-time low for us, and then hedge funds, also an all-time low. The real story over the last couple of years has been the dramatic continuing evolution of private equity, growing to about 20% of our members' portfolio.
So that's great news for us, obviously, and for probably the ARCRAD members who are listening to us. The question I've got, a couple questions here. Number one is, what percentage of those, that 20% asset allocation into the private equity sector is in fund products, or what percentage of it is direct investment into deals? Do you have that kind of data?
Yeah, in fact, about 66% of the 20 is direct investments in our members' own or other private companies, and the rest, about a third apparently, it fluctuates between 20% and a third, is in funds or separate investments. So depending on whether people make a direct investment in a single venture capital or private equity, and of course our private equity covers LBOs and literally ownership of private companies. But for Tiger members, the majority of these allocations are still to companies they own or control, but there's a very significant portion, and if you think of our asset pool as $40 billion more or less, 20% of that is about $8 billion, and about a third of that is about $2 billion. So I think we have a little over $2 billion, closer to $3 in funds and direct investments where our members are passive investors. They're not on the board and don't control it. And the just to finish,
go ahead.
I was just going to say that obviously the sectors that they're most interested in are healthcare, technology, and real estate.
Well, this is obviously great news again for our partnership between ARCRAD and Tiger 21, and it obviously shows a lot of commonality of interest. One of the questions that our investors often ask is, you know, given the fact that if you're going to make these risky investments in private equity or certainly in technology or healthcare kinds of startups, what kind of diversification do you need? How many companies does Tiger recommend to its members do you need in your portfolio to get that? Is it 5 companies? Is it 10? Is it 20? Does it matter? Are there different kinds of metrics you look at? But how do you counsel your members in terms of the size of your private equity portfolio, especially those direct investments?
Yeah, so the first thing I just have to say, we make no recommendations whatsoever. We're not an investment manager. We're literally the plumbing that brings together members, and our process allows members to learn from one another, and then we aggregate what they have learned to try and glean some information from the collective intelligence of our members, because they're an extraordinary group of people, and every one of them has basically created extraordinary wealth from very modest beginnings. But with that being said, I think that there's a real range, and maybe I'd rather give you an answer of how I would think about it than give you the answer, a single answer. And one of the things that is very important is many members put on one hat when they're making passive investments and forget that in the other hat they have expertise. They sort of sell a business, and then all of these advisors come and tell them they should put a passive portfolio together like an endowment or a foundation fund. And we've been really focusing on trying to have members think about what they know about, because if they can make investments that in any way relate to their own life experience or one step away from their life experience, then they might have different concentrations than if they're just making passive investments across a portfolio. And the other thing that I said is that the riskier the asset class, and obviously venture capital is risky, it's exciting, but it's risky, you'd want more investments rather than fewer investments. So if you were talking about private equity, typically in a portfolio that has a third of the 20% allocated to funds or other investments, I would think that, generally the number would be 5, maybe 10, but the minute you start skewing towards venture capital, I think the number starts going up because you need to spread your risk. And not by way of recommendation, but observation, it seems to me that the portfolio defenses that I've participated in of the members I respect the most in the technology and venture capital world, I'm always amazed that they seem to have literally a couple dozen or more investments where even if somebody is worth $100 million, they're making $50,000 to $250,000 venture capital bets. When the companies are a little more mature, they tend to move up and run into the $1 million to $5 million range. So I think obviously the smaller the average investment, the more you can have, the more you can spread the risk. But frankly, venture capital is the only sector where diversification ends up as diversification later and later, meaning you would not buy that many stocks. If you have a stock of a portfolio of 100 stocks, I don't think you get much more diversification than the market, but I have seen venture capital investors with dozens of investments.
It's very, very interesting. And by the way, I think that follows a lot of our own expertise and our own sort of best practice, which is that, if you're not doing a venture portfolio, especially in the early stage of 10 or more, and probably 20 is a good starting number, I think you're taking too much risk. We appreciate that. Now, I understand that you also put emphasis in Tiger 21 not just on investing in areas that you have expertise among your members, but in terms of their ability to potentially mentor or get involved in the deals themselves. How important is that in an average Tiger 21 member's successful investment strategy?
I think what I'd like to say is the following. A generation ago, people worked for 30 years. They created wealth either in their company stock or whatever it was, and then they retired. And they had this notion that they could just sort of turn their assets over to wealth managers and be done with it. We don't see that happening anymore. We see our members, the big story with our members is after they've had their liquidity event, they still are kind of rolling up their shirt sleeves and getting involved in businesses. And obviously you could get on the board, or you could be an active investor, or you could play a role, or you could create a portfolio of related businesses. So I happen to be the chairman of a public company in Canada that is in the solar business. So I'm a little more focused on some venture capital and private equity businesses related to alternative energy and batteries and new solar panels and so forth. And at least I'd like to believe that when a new investment comes in, I already have a base of knowledge from these other investments. And I think the simple reality is that we live in essentially a zero interest rate and probably a negative real interest rate environment. This is the first time in our lives pretty much with low interest rates. What it means is if you do nothing, you go backwards. So our members are finding that they have to work much harder and be much more focused and take much more responsibility for their investments than maybe the norm was a generation ago. For those who like doing that, it's really exciting. It keeps them active. It keeps them in touch with what's going on. But regardless of whether you like it or not, that's the world we live in. And so we really try and help people become the CEOs of their investment company. It doesn't mean they can't delegate it, but psychologically, they really have to own it. They can't give it to a third party. So I think what I'm trying to say is that this historic notion that you could just invest money, it doesn't exist anymore. And so it's a lot harder, and people should be realistic. They should find ways to associate with great managers, great entities. They should find ways to have peers give them second guesses. But fundamentally, I think this is, I was impressed when President Clinton noted that some presidential candidates don't know that politics is a contact sport. And I think the same thing could be said for investing. This is not easy. It takes work, and anybody who trivializes it is going to be really fooled. But for those who are willing to be the students, it turns out that luck tends to favor those who are prepared and willing to take the risk.
Amen to that. In terms of when you and your members look at investments, I mean, everybody has their favorite criteria. What really turns you on personally, or what do you think from the best practice you've heard in the various, of the 30 groups? What are the really sort of insights into what makes a great deal? I mean, everyone, loves to hear, okay, what is that? What do I really need to focus in on?
The learning that I'm working with in my career right now is that we look for 4 things and try and have the discipline, and now I'm speaking just for myself because I'm not sure that I could aggregate 300 different points of view. But when it comes to venture capital, we want to know management first and foremost. We've seen too many good deals where great ideas were screwed up by mediocre managements. So to me, without a great world-class management that has a kind of demonstrable edge and expertise and skin in the game and is credible, we just won't touch it no matter how great it is. So that's the first. And in management, sometimes we do background checks, integrity checks. We want to make sure we know who we're dealing with. But the generic category of management is number 1. The second is market. We're not interested in backing products that, if they're wildly successful, have a $10 million market, because there's just not enough juice. There's not enough juice to squeeze. So we're looking for products and services that can really scale, that have, as a minimum, kind of $1 billion market and maybe a multi-billion-dollar market. We have to have a credible story as to why that market exists if it's for a new product. And then the third has to be sort of technology. Is there any unique technology that is defensible? We've seen lots of deals with great management and great technology that's defensible. It's just the market isn't big enough to justify the investment. So we want to look at each of these 3 things as unto themselves and see if we can check the box on all of them. And then the fourth is that, we want to, it's sort of the size of the market, but we want to have a credible runway to a kind of 10x return over 5 years. And obviously, if you only got 7x, even though you thought you were getting 10, that would be great. And if you get 50x, all the better. But very often we've had amazing managements that seem to be going after big markets, and they have some unique products, but their own model doesn't get to a 10x. And if the management doesn't have the aspiration and vision how to create it, I certainly can't push them from behind. So I would say those are the 4 things that I would be most interested in.
It sounds like we've got a lot in common in terms of the way that we look at companies. The last set of questions, and I think we'll throw it open to the audience. We've got a good crowd here on. at the moment is when, we've been speaking about different kinds of investments. There's a lot of excitement in the market today about impact investing. We've heard that as a buzzword. And how do you guys look at that in Tiger 21? Are more and more people asking about it? Are they trying to figure out what is the strategy? Are they sacrificing profits in favor of social good, or they believe that you can make them both an impact and make profit at the same time? What's the trend
John,
there in Tiger 21?
We obviously didn't get a chance to talk before today about this, so I don't know whether you know that you're setting me up or not, because I was the keynote speaker at the Impact Capitalism Conference in the spring. This is something that I, again, am speaking for myself, not all of Tiger members, but I think impact capitalism is about the most important trend of our time. And just to remind everybody, it basically says, when can you invest where you have a double bottom line, where part of it, where one bottom line has to do with profits and the second bottom line has to do with benefits to society of one sort or another. And while on the one hand the term can be broadly used, in my own context it's around the environment. And I think that the basic notion is the following. If you think of a spectrum, at one end you have philanthropy, which obviously is giving away money to causes that you believe have great social impact. And there's a new trend in the middle, which is doing things where you invest with low returns, but you get your money back. So a foundation will back a farmer that's going to create an organic farm. After 10 years, the farmer can buy the farm, and so the foundation gets a 2 or 3 or 4 or 5% return and gets to recycle the money. But at the other end of the spectrum is what's called impact investing. And impact investing starts with the premise that you don't have to sacrifice profits to have investments that are good for society and the planet and the environment. And you don't have to sacrifice the environment to have proper profits reward you for the risks that you're taking. And it sets the bar at a much higher level when you have to use both metrics. But I just want to stress, in the 60s, Milton Friedman, the famous economist, said that the sole purpose of a corporation is to serve and enrich its shareholders. But in a recent survey of 5,000 millennials, they're redefining the corporation to pursue social good. And I think that the balance between the two is to find cultures where you can create capitalists, where people are pursuing the profit motive, because if you don't, you won't attract the levels of capital needed to address the issues. I think that's really the point. Not only that personally I'm excited to but rely on the philanthropic sector to address these issues. There's just not enough capital there. There's only $300 billion of contributions in the U.S. given annually, and if you take out synagogues, churches, and schools, the number is woefully small. There's 100 or 1,000 times those resources in the private equity and foundation, in the endowment worlds. So we want to harness the capital to make the changes in the world that are going to create the next generation for us, and you can only do that when you are harnessing impact investing. So I think the bottom line is it's a higher standard of behavior, it's a challenge, but it's probably the most exciting thing people can do with their capital today.
Yeah, we totally agree here. And I'll tell you, in Israel, we're seeing a huge spike in interest in I think we share the same definition of impact investing. We don't want to sacrifice profits at all, because frankly, by investing in companies that will make great profits, you're going to have that sustainability. Companies will be able to keep on coming and creating that social impact. If you look at our portfolio at the moment at our crowd, out of the 90 or so companies we've invested in in a little less than 3 years, about 25 of them, or close to 30%, are bona fide impact investments. Our first IPO was the company Rewalk, which allows paraplegics to get up out of their chair and walk again. And that was a classic, impact investment. People made money. It's doing great things for the world. I'd love to get some questions from the audience. If you can text them in, we'll be happy to pass them on, to Michael. In the meantime, I'm going to ask you a question, Michael, because you talked about impact investing and the environment. A lot of people are not sure about what the impact is of this Paris Accord in terms of business and how to play it. Okay. What do you think? I mean, alternative energy investments have been a minefield, right? In other words, there have been some that have really worked out, but there's others that have been spectacular disasters.
Right.
Where do you think, our investors, we as our crowd, or our members should, your members should be looking to find the next big thing in a post-Paris environment? And I don't mean the terrorist attack. I mean the climate change stuff.
I understand. First of all, I think Paris has to be kept in a perspective. It's a dramatically important diplomatic accomplishment for which all of the participants should be rewarded or lauded, because it takes us from the Kyoto regime, where only the developing world was responsible for reducing CO2 emissions, but it turns out that all the growth in CO2 emissions is in the developing world, not the developed world. So China and India were excluded in Kyoto, even though all of the growth in emissions going forward are in the developing world. So for the first time, we have a global pact where 96% of the emitters now come under the same regime, and there's a framework that goes out on a multi-year basis. But the fact is that what happens is this framework still leaves to each individual country how it's going to meet its challenges. So some will use the marketplace, some will use regulation, and hopefully most will, one way or another, address their challenges. But one should not be, this is not a panacea. The best estimates are that if you take what's going on in Paris, it'll only get us to 3.9 degrees instead of the 2 degrees centigrade that some believe is critical, and now the 1.5 degrees that most people are starting to focus on. So you could argue that Paris started a process, got us on the right track, but by no means does it mean that climate change has been solved or addressed. It just has created a framework for the first time that has never been in place before. So having said that, I think that the overwhelming takeaway is that fossil fuels will have limited future. You see that in coal already, where most of the American coal companies are bankrupt or dramatically down. Oil will probably will follow, but it may be decades, and gas probably has a longer life. But in terms of alternative energy, probably the areas that, things that save energy, anything ranging from mass transportation, but in energy sources, geothermal, wind, some would say nuclear, solar, and I think the holy grail of them all is battery. If the area that I'm most interested in is battery technology, because where you have intermittent producers like solar only when the sun is out and wind only when the wind is blowing, the only way they can effectively solve long-term energy problems is when there's better storage. So I think if you look in the future, battery technology will be as important as oil turned out to be if we were sitting 100 years ago. But obviously, all of the things that will shift as oil is wound down and later on gas, and as alternatives are wound up, are things that are over the horizon, and some of them are here today. There's really exciting battery technologies that are here today, and next generation solar. But you know, it's as endless as the human creativity can conjure up.
So speaking of here today, I'm going to make a short, shameless promotion of one of our social impact deals, which is actually live now on ourcrowd.com, which I would urge our listeners, if you're interested in actionable sort of information, here it is. There's a company up on the site called Enverid, E-N-V-E-R-I-D. It's a brainchild of a brilliant Israeli professor at MIT who's licensed Department of Energy Technology from the U.S. to essentially create the world's most advanced air conditioning air scrubber. So advanced that it actually reduces by 90% the number of cycles you need for clean air in a building, and thereby reduces the energy footprint of what's called HVAC, or big high volume air conditioning, by about 40%. And it turns out that air conditioning in buildings is one of the top 3 uses of electricity in America, and you should take a look at that company. It's being led by a very reputable private equity fund. We've got a chunk. This is our 3rd investment in this company. And if you want to find social impact, you don't have to look much farther than Enverid. But if I had to ask you, Michael, about an area people have been hearing a lot about, which I think is cool and fun technology. Certainly we're playing a leading role here in Israel, and might actually have some real impact in terms of energy usage, is this whole autonomous driving business that, you know, is coming out of Google and whatnot. We have here in Israel, our local hometown hero in Jerusalem, Mobileye. Do you think this is real as it's hyped up to be? Do you think that we're all going to be driving and taking jacuzzis at the same time, or you know, or do you think that this is still Jetsons stuff for 10 years from now, rather than real business in the next year or 2?
You know, I think the nature of the adoption of technology is that we all adapt to new technology so quickly, we forget how quickly we do. You know, the fax machine is 30 years old, the iPhone is 5 or 6 years old, the portable computer, and when you look at the way we lead our lives, we forget how quickly we've adopted technology, and there's almost always this kind of question that you're asking, which is, I can't imagine that we'll adopt autonomous driving, but then you find yourself 5 years down the road and you've been driving in your autonomous car for 2 years, and you said, I can't believe I didn't have this. So I think autonomous driving, first of all, it's not in the future, it's already here. The new models of Tesla you know, have elements of autonomous driving, and any number of companies' cars already can park themselves in a double parking lot. And in my Mercedes, when I'm driving on the highway, if the traffic stops in front of me, my car automatically slows down and speeds up again when traffic gets going. So, you know, we're not too far away, and frankly, when I'm driving at night, if I start veering off the lane and I go across a yellow line, the car starts beeping and telling me the steering wheel starts shaking. So all of the elements are already in place, and step by step they're already coming in, and the accident rate is predicted to be so dramatically less. And the fuel efficiency, just think of a taxi company where you know, instead of you having your own car, they can program a very small number of cars can support a much larger number of people when they're autonomous, because when I get out of the car now, I have to park it in a parking lot near me, but if it's autonomous, it can drive to the other side of town and pick the next person up. So the efficiencies of autonomous driving, particularly in urban settings, have not only to do with changing our life, but dramatic fuel efficiencies. So the 2 parts that are most interesting about autonomous driving is even when you're on cruise control, your car is dramatically more fuel efficient than when you're driving at the same speed yourself. So there will be dramatic fuel efficiencies that are realized from autonomous and semi-autonomous driving. And on top of that, there should be dramatic reductions in insurance costs because the computer doesn't sleep, whereas sometimes people fall asleep at the wheel. So I think I'm not predicting that within 5 years there won't be a person on the road that's behind the steering wheel, but I am predicting that within a pretty short period of time, all of us are going to be affected in increasingly important ways by elements of semi-autonomous and autonomous driving.
Yeah, I would really agree. And by the way, much of that is being powered by this incredible company here called Mobileye, which is just, supplying 90% of the world's auto manufacturers with this technology, saving lives and saving energy. It's great stuff. One last question about another hot area that is sort of surprising that the venture herd, if you will, is now moving very aggressively in this area. It's everything food. It's just bizarre to watch. There was the food conference just recently, food technology. It literally smack-packed with every venture capital fund from Silicon Valley. Everybody's excited about their fake mayonnaise investments and whatnot. And you mentioned earlier about that social impact, case of helping a farmer with a loan. There seems to be a real interest in changing the world's, food supply and food supply chain in the venture side. Do you think that's an area worthy really of serious attention by the listeners?
Well, just by way of full disclosure, my wife is a chef and cookbook writer and has just published the JCC Community Table, which is enjoying a lot of success. So we focus a lot on food, but I think that there's a lot of activity going on in food because for many years all you had was the growth in agribusiness, and there's been some amazing advancements, but some also very serious issues that have been built into the food chain. So when you talk about the health of various crops, there used to be literally dozens of different wheats that each had their own strength, but with larger and larger agribusiness, there's fewer and fewer, less and less diversity, which allows crops to be more at risk. So I think what you have is two trends. One trend is new foods, however done, and the second trend is back to basics with the family farm and organic farming and preserving the past. So as one part of the community is marching into the future, the other part of the community is preserving the past, and they both provide amazing opportunities for investments, but of a different nature. I mentioned that on the organic farm side, one form of social activity is supporting organic farmers. But I think there's endless other food packaging and food types that will happen, and hopefully it'll stay in balance. I know there's a lot of controversy about genetically modified food, and in particularly in Europe staying away from that, but at the same time there's endless new opportunities. So I think it's kind of on a case-by-case basis and also reflective of people's own views about the evolution of food.
So this has been an absolutely, by the way, I couldn't agree more on this issue of food, especially your point of both seemingly contradictory, moving backwards and moving into the future. We actually have another deal, and that's the last shameless promotion I'll make, on the site now called Bouqs, as it's short for bouquets, which allows you to actually order flowers direct from the farm in Latin America to your house in North America. And so you get not only the freshest kind of flowers you've ever seen, but you now know exactly which farmer grew them on the edge of which volcano in Ecuador. It's quite remarkable. It's actually a joint venture from Ecuador and the U.S. Company, by the way. Revenues are growing at about a 300% rate year to year, and that's up on the site. And what we're finding is that people like the notion that they're going backwards into the family farm and being able to identify with that individual flower grower, but then getting the benefits of modern e-commerce and logistics where the flowers now are fresher than ever delivered to you on your site. Michael, this has been a wide-ranging conversation from food to alternative energy and autonomous driving, asset allocation, mentoring, and yes.
I just want to go back because there's a part of the question you asked for me about impact investing and the conference, and if we have time, I'd like to share one more example.
So please do, but I wanted to, please share that, and then I want to make a final comment about how people can get in touch with you and Tiger 21 before we bring this to an end. Go ahead.
Great. So, one of the things that's going to be happening as a result of oil prices or less and less fossil fuels is the role that solar will play. And a lot of people don't realize that this isn't whether the cost of solar is simply less than the cost of electricity produced by fossil fuels, because when China evolved, they didn't put in a landed line phone system. They went immediately to wireless system. And so one of the economic benefits of solar is that it's wireless. So for instance, in the lighting business, you save all of the trenching underneath the ground that connects lights to the power source, and sometimes the cost of solar is now literally less than the savings you get just from avoiding the wiring. Solar today is 10 times cheaper than it was 10 years ago. It used to be $5 a watt, and it's now 50 cents a watt. And lighting is 3 to 6 times brighter with this LED revolution. So when you think about the development in Africa with microgrids, the savings of the microgrid is not only that solar is cheaper and you need less power to light lights and many other appliances, but you save the wiring costs. So it's not comparing the cost of solar to the cost of oil. It's saying just the installation, if it's cheaper, oh, by the way, the energy is free. So I think when you're looking at the developing world and you think about alternative energy, you have to make sure you're asking the right questions. It isn't simply whether one form of energy is cheaper than the other, because one form of energy can produce distributed energy anywhere you want it. You can put a windmill anywhere or a solar panel anywhere and avoid all of the infrastructure costs. And also when you put in a power plant, sometimes you have a minimum cost of $100 million where you can put in a $1 million windmill and light up a small village. So it's not only distributed power, it reduces the scaling effect, and that's why part of the effect of Paris will be to further accelerate this exciting trend, which will open up the possibility of hundreds and hundreds of investment opportunities.
Michael, I just want to thank you very much. This has been a, sort of a classic Our Crowd Tiger 21. I've attended your events. I've seen how wide-ranging and intense the conversations are, and we like to pride ourselves on the same. We look forward to doing many additional webinars and face-to-faces, both with you and your members. And I want to thank you. For those who want more information about Tiger 21, I think the information is up on the slide. Contact Kristen, and she can also put you in touch with Michael if you have any questions for him. I'm again John Medved. You reach me at john@ourcrowd. We want to remind you that on January 24th through 26th, there is the Our Crowd Annual Global Investor Summit. We're close to 2,000 registrations already, would you believe? It's the largest investor conference in history ever held in Jerusalem, and we'd like to welcome you to come. So if you feel like coming to see a beautiful time of year here in the Holy City and the city of entrepreneurship, come on down and join us. Again, thank you, Michael, for being with us, and thank you all for listening. We'll talk to you soon next time. That's it for the webinar tonight.
Thank you.